Hey traders, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, March 26th, 2025. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Well, first, we need to take care of some housekeeping items. The video is a little bit late tonight, as we know. However, I am traveling, and that's going to happen over the next several days. From time to time, it will be earlier or later, and potentially, like last night, even a miss or two. My apologies. I hate to miss a video, but this is family time, and hopefully you can understand. Let's get into the action. So today is what they call a pullback day. Let's review what happened in the markets over the last couple of days and see if this is an anomaly or see if this is normal garden variety market activity. If you take a rough draft of a fib retracement from high to low and back up, you've returned or retraced about 0.382 of the move from high to low, retraced 382%. Basically, that's a garden variety retracement. So it's no wonder that today was a pullback day. It didn't have to be. They could have continued up to the 50%. They could still continue up to the 50% or more. We're just going with what we have today on the board. Now, let's focus on what happens tomorrow. What are our options? Well, the obvious or Captain Obvious option is the market could go up and it could go down. We all know that. It's a joke, it's in jest. But let's take a look at this thing from a realistic perspective. The market could come down and fill this gap over here officially at 563.98. We'll just call it 564 for argument's sake. If she does that, everybody will think the market is collapsing back down, ready to make new lows. That may or may not happen, but that's what will be discussed in the webosphere, TV, all that stuff, blogosphere, Discord, YouTube. Don't forget, the market's job is to trick, trap, fool, and frustrate as many traders and investors as possible. This is a weekly chart. We're going to keep tabs on the weekly chart. Is she going to be above or below the 50-week moving average? It's extremely, and we'll add in uber important. Big time money managers use the 50-period moving average as a gauge. When stocks or an index is above the 50-week moving average, they're comfortable. When it's below, they get ants in their pants. Ants in their pants is a technical phrase. Write it down, put it on a sticky note. I'm going to give you something else to look at also. Now we're looking at the monthly chart. What's important on the monthly chart? How about the last big time breakup candle low in the sequence? I've demarked that low with 567.89. If you're looking for that low, can't find it, it's right here. Last big time breakup candle low in the sequence. So market is officially eating time off the clock, building energy for another move higher as long as she stays above and closes month after month after month above that breakup candle low. But, and this is the reason we're bringing it up now, because we're approaching the end of the month. What happens if she closes the month below that number? It doesn't have to be a tell-all. It's not a death sentence, but it certainly is what we call in the trading parlance a shot across the bow. It's something we want to pay attention to, because if she gives that up on monthly close, she's susceptible to fall further. I would write that down, put it on a sticky note. Back to the daily chart. We'll take it day by day for now, but we know what we watch at the end of the week, the 50-week moving average, and we know what we watch at the end of the month, which is the big time breakup candle low. There was no inside the numbers commentary or stocks on the move today. I had the day off as I was spending it with my family all day. We're on what's called a overdue vacation situation. However, tomorrow there will be inside the numbers, there will be stocks on the move, there will be a live room. So, as far as reviewing inside the numbers in this video, we're not going to do it. We didn't have it. So, we'll just skip over it and move on to Camp IWM. Anything different found on this chart from the SPY chart? Not really. Again, it was a pullback day. Just like the spiders, the IWM was down about 1%. Can they come back and fill the gap tomorrow? Absolutely. Can they bounce back up and just continue eating some time off the clock? Absolutely. And again, here we go with, hey, the market could go up and the market could go down. That's correct. We don't know which one it's going to be. I'm giving you all of the alternatives. When you look at the weekly chart, she's well below the 50-week moving average. Remember, the trend is your friend until your shit gets thrown out the window. She's certainly in a downtrend like other markets. We don't want to lose sight of that. Just because the market's bouncing up right now, minus today, doesn't mean she can't have another swoosh down lower. You know, when you go back to the daily chart, you say, hey, market went down, found a low. We talked about the low. We're not going to belabor that point. Now the market bounces up, wants everybody to believe she's in recovery mode, but can she actually just do this, make new lows, and get everybody scared out of their shorts? Absolutely, that can happen. That doesn't obviously just apply to Camp IWM, but that applies across the board. The spiders or the S&P, the Dow, everything. Remember, it's all the same market. When you have big moves, they're all going to go together, although not every time. Therefore, let's take a look at the folks down at the transportation department. So the transportation department was up about 0.6% today, or about 85 points. How do we explain that? She's actually eating time off the clock right here, building energy to make another move higher. Why do we want to pay attention to this? Because not only is this my second favorite market leading indicator next to Camp IWM, but this is our favorite canary in the coal mine. The transports act as a warning signal, whether it's in the upward or downward direction. That's what a canary in the coal mine does. So we want to heed this information. Weekly chart, nowhere near the 50-week moving average. In fact, below all the moving averages. We know the story, we know the jingle. The trend is your friend. But is she going to recapture the 200-period moving average as she tries to climb the last big-time breakdown candle in the sequence? We're going to find out sooner than later. Transports, canary in the coal mine, write it down, put it on a sticky note. What about the Q people today? She got whacked a little bit more than the other markets, down almost 2%, down 1.84%. I'm sure the people on Tout TV had a good reason why. We don't really care what their reasons are. We just want to know what's going on the charts with the numbers. I want to point something out using volume as a gauge. So what you'll note is the volume was on the rise as price was coming downward. And this applies to most all the markets, if not all the markets. So price is coming down, volume is on the rise. That tells you there was institutional participation. Now you'll see volume kind of starts to go in the downward direction as the market bounces back up. I get a lot of notes and messages from traders saying, hey, aren't you concerned about the volume being lighter as the market bounces back up? And the answer is no, that's actually the way it works. For some reason, there's a volume boogeyman out there that has people believe that if the volume is light and the market's going back up, it's going to collapse. If you look at the charts from, for example, 2009, after the financial crisis, that's the way it works. Don't take my word for it. Just go take a look for yourself. What about the financials? Well, you know how I feel about the financials. If there's nothing wrong with the financials, it's unlikely there's anything wrong with the underlying structure of the market. Well, the financials were down 15 cents today, or 1/3 of 1%. It's what we call in the trading parlance, no big deal. Sitting right on the 50 period moving average on the daily chart, weekly chart, sitting on the 20-week moving average above all the rest. That's a healthy market, all things considered. Doesn't mean she can't come back down. No, it doesn't. But it's a healthy market today. We take the market at face value each and every day. Now, on the flip side, we have smash mouth or the Philadelphia Semiconductor Index. She was down over 3% today. We're going to call that a semi woodshed day, taken out behind the woodshed, shot 3 times. It's one of those things. Can this be going on? You have a move down, and then you have a recovery operation, a retracement, if you will, and then all of a sudden you have the third leg, which is down, making new lows. So this would be a corrective ABC type of pattern. A leg down, B leg up, C leg makes new lows on an official basis. Doesn't mean she has to stop at the new lows, but that's what it is, an ABC pattern. We've talked about them for years. That could be what's going on here, certainly across the board, and especially in the SMH. From a weekly chart perspective, you have a crossover situation coming where you have the 20-week moving average about to cross over the 50-week moving average while she's below the 50-week moving average. Again, back to the money manager thing, we have to heed markets below the 50-week moving average. That's what we call in the trading parlance an unhealthy charting situation. We're going to leave it there. Have I told you how much I appreciate each and every one of you? Without you, these videos, they're not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.